Up next, we're looking at Capitec and African Bank's insurance business. Paul?
Just to summarize, really what this is about credit risk. So African Bank has a stated arrangement whereby they put in place with the loans an insurance policy. One of the factors that resulted in this big write-down in this week's results is they provided nearly 450 million rands worth of additional amounts for liabilities potentially arising out of their loan book as a function of a wider definition of retrenchment. Because one of the things that happens is that if you get retrenched, or if you die, or if you lose your job through, incapacity from an injury or something, then the loan gets paid off by the insurance policy. So that's an internal thing. It's part of what African Bank makes, is the net yield on the loans that they advance is partly interest, partly a fee when you start out the loan, and partly an insurance portion, which accounts for about 5% or 6% of the total yield.
Anything further to add?
Yes, so although it might be 5% of the yield, if you look at the costs associated with insurance, you don't have operational costs, you just tick a box and you get the insurance, and you have claims cost against it. In the last 6 months, African Bank had 2.4 billion rand of insurance income and 800 million rand of claims. That leaves 1.6 billion rand of profit from insurance operations. After tax, that's just over $1 billion. Their bottom line was $1 billion. So all their profits currently are coming from
the insurance business.
Correct. So that's a huge risk at the moment. The bad debts have eaten up all the profitability from lending, and all their profits are actually insurance.
So now they're de facto insurance.
No, but that's sophistry, because you can describe that the insurance business doesn't exist separately. It's not like they're trying to take business away from Sanlam and sell life insurance policies. It's linked to the loan. So there are times, as you would when you have a substantial net outflow as a result of those operations, and times when it's more profitable. It's a decision. The management team can decide.
But let's just go back to the sum of the parts there. If you took the insurance business out and you took those profits out of the fold, we would have seen a net loss out of Able.
But you don't sell insurance in this, you don't sell loans in this environment without the insurance element.
Well, it's not compulsory. So any client could actually, at the point of sale, say, no thanks, African Bank consultant, I don't want the insurance, I'll go somewhere else. They don't do that because of the point of sale pressure that's put on, whether directly or indirectly, and they all tick that box to take the insurance.
Does African Bank have the right to refuse the loan? In other words, they have to indicate that there is alternative insurance cover.
Yes, so it's more effort to go somewhere else and get the insurance. But it's clear, if you look at the claims ratios of 30% versus a normalized claims ratio somewhere else of around 60%, that African Bank's insurance is very expensive.
Capitec doesn't have an insurance offering, or
Correct.
does it?
They don't. They don't charge insurance to their end clients. What they do is they insure their book themselves. So if one of their clients gets retrenched or disabled or dies, Capitec takes out insurance to offset the loss that they might take on the debt outstanding, which contrasts to African Bank, which charges the end client for that coverage.
In total, is this a net positive on from your perspective when it comes to African Bank?
It's a net negative. It's a huge
did I say net positive? I mean
yes,
net negative.
It's a huge regulatory risk. The regulator is looking into credit life insurance. If you compare the claims ratios on African Bank, the only guys that are worse are some of the furniture guys like Lewis and JD Group. Not a great space to compare. If you're talking about insurance, it should be affordable. So it is a big risk that the insurance income could be cut substantially if regulators grasp.
I was supposed to be looking at you when I said net positive. I don't know what I was thinking.
In the marketplace for loans, people know what the amount is that they're looking to borrow, and they know what the monthly payment is. So people are not, the comparisons come out in the end. In other words, if it was just an African Bank branch and a Capitec branch right next to each other, people are going to go where the credit cost to them net is what it needs to be, inclusive of all of the associated insurances and other things. So if African Bank was pricing themselves out of the market because they were charging too much for insurance, it would have come out in the loan advances.
So you think it is a net positive?
No, I don't think it's a net positive or a net negative. I just think it's the nature of the business.
I've never heard you talking like an economist.
Well, that's fine. Look, sounding like an economist.
It's neither positive nor negative.
I thought you were going to say that I was talking as someone who is long the stock, but remember, JP's...
No, you're indecisive. You're never indecisive.
Hedge fund that he works for are short the stock, so you must take everything...
Yes, you're right. I must keep reminding you you're short the stock. Absolutely.